Hi, we're going to work through exercise 2-9 and 2-10. So we're to prepare general journal entries to record the transactions below for Spade Company by using the following accounts. So our chart of accounts includes cash, accounts receivable, office supplies, office equipment, accounts payable, common stock dividends, fees earned, which is our revenue account, and rent expense. So we're going to do the journal entries first. Then we're going to post them to the T accounts, which represents the general ledger. And then at the end, we're going to determine the ending balance of each account. So the first business transaction, Casey Spade, owner, invested $100,750 cash in the company in exchange for common stock. So just like Chapter 1, we identify at least two accounts that are affected, what type of account they are, and if they're going up or down. We're also going to be looking at the type of account to determine if it's the debit or the credit. So for A, we have two accounts, cash, which is an asset and is increasing, and common stock, which is an equity account. It is also increasing. When an asset increases, it's a debit. When equity increases, it's a credit. So for our first journal entry, we're going to debit cash for $100,750, and we're going to credit common stock, which is equity, for $100,750. Then we're going to go to our T accounts. We're going to go to the cash account. We're going to post a debit of $100,750. Remember, debits are always on the left. And we're going to go to the common stock. And we're going to post the credit of $100,750. Then we're going to go to transaction B. The company purchased office supplies for $1,250 cash. So we have office supplies and cash. They're both asset accounts. Office supplies is increasing, so that's going to be our debit. And cash is decreasing, so that's going to be our credit. So our second journal entry, we're going to debit office supplies for $1,250 and credit cash for $1,250. Remember, debits are always listed first, and they're going to be on the margin. And credits are going to be listed second, and they're going to be indented. Your debits always have to equal your credits. Then we're going to go to our T accounts, which represents the general ledger. We're going to post a debit to office supplies and a credit to cash. So we have our office supplies. We're going to show the debit of $1,250. And we're going to show a credit to cash of $1,250. On C, the company purchased $10,050 of office equipment on credit. So the two accounts are office equipment and accounts payable. Since we're going to pay it later, we bought it on account, on credit. Office equipment is increasing. That's going to be our debit. And accounts payable, which is a liability account, is increasing, so that's going to be our credit. So we're going to debit office equipment for $10,050, and we're going to credit accounts payable for $10,050. Then we're going to go to our T accounts, and we're going to do the same transaction for every one. We're going to go to office equipment and post a debit of $10,050. We're going to go to accounts payable and post a credit of $10,050. So we have office equipment, debit $10,050, and accounts payable $10,050. I'm not going to continue to go through all of the transactions in the T accounts, so you would just post them from the general journal where we post the journal entries. On D, the company received $15,500 cash as fees for services provided to a customer. Fees, we've earned some revenue. That's going to be equity account. That's going to be our credit. The other account that's affected is cash. Cash is coming into the business, so it's increasing. When an asset increases, that's our debit. So we're going to list our journal entry. We're going to debit cash for $15,500. We're going to credit fees earned, which is our equity account, for $15,500. So notice if you're not really sure which account is the debit or credit, and cash is involved, cash is the easiest one, so do that first. If cash is coming into the business, it's increasing, that's a debit. So then you would know that the other account has to be the credit. And if cash is going out of the business, you know that's going to be a credit. In E, the company paid $10,050 cash to settle the payable for the office equipment purchased in transaction C. So C, we already recorded the purchase of the asset office equipment. We're just paying our bill. So we have accounts payable, which is our liability account, and it's decreasing. We're paying off what we owe, so the accounts payable is going to be a debit because it's a liability account. Cash is going out, it's decreasing, so that's going to be our credit. F, the company billed a customer $2,700 as fees for services provided. So we've earned more revenue. Revenue's an equity account, so that's going to be a credit. And instead of receiving cash, we're going to record accounts receivable. Accounts receivable is an asset. It is increasing, so now they owe us some money. So we're going to debit accounts receivable, and we're going to credit fees earned. On G, the company paid $1,225 cash for the monthly rent. We're going to record rent expense. Expenses are always debits. They decrease equity. So you'll know that we're going to debit rent expense, and we're going to credit cash. In H, the company collected $1,125 cash as partial payment for the account receivable created in F. So again, F, we already recorded the revenue account. We're just recording that we are receiving part of the amount that is owed to us. So we have accounts receivable, and we're going to have cash. Cash is increasing. We are receiving cash, and our accounts receivable is going to decrease. So that's going to be our credit because now they owe us less because they've paid part of what they owe. So we're going to debit cash for $1,125, and we're going to credit accounts receivable for $1,125. And the last transaction, the company paid. Paid is a clue. Cash is going out, so it's going to be a credit to Spade, who is the sole shareholder. So we're going to record that as dividends. Dividends are always debits. They decrease our equity. So we're going to debit dividends, and we're going to credit cash. So these transactions can be confusing as far as the debits and credits. I would just suggest a lot of this is going back through and practicing, going back through the PowerPoints, practicing the journal entries, and you always refer to your accounting equation as far as what type of account they are and if they're going up or down. Next, I'm going to just finish posting these in total. But again, you would do them one by one. So you're going to list all of the transactions for each account. Then you're going to determine the balance. You're going to add up the debits and subtract the credits. So for cash, we have a balance of $94,850. We would go to our trial balance, and we would post for cash the balance of $94,850. So notice you're not going to put a debit and a credit balance. You're just going to post the net amount in the debit column. You're going to do the same for accounts receivable. and for office supplies, and for office equipment. Accounts payable. We have a debit and a credit for the same amount, so it's going to be a zero balance. Common stock, $100,750. We have our dividends. We have our fees earned. You can see they're just added up. And then we have our rent expense. So after we put the totals for each account, we're going to add up all the debits, we're going to add up all the credits, and we're going to make sure they are in balance. If they're not, we basically backtrack to find out where there is an error. Your debits have to equal your credits.